Good morning, everyone. And really what I'd like to discuss this morning is how every year there are 2 or 3 key themes which can explain 80% of the market's volatility. And we don't think that 2021 will be any different. But before we get into what we think those will be exactly, I think it helps just to set the stage going into the new year. And I think it's fair to say that most of us are suffering from a certain level of cognitive dissonance. And that is, our experience on the ground doesn't match up with what we're seeing play out in capital markets. On the ground, we're witnessing job losses. We're witnessing business failures. We're living under restrictive lockdown conditions, and the macroeconomic data doesn't look positive. And yet in the capital markets, we've seen a rapid recovery. We're reaching new all-time highs, and we've got a fairly fervent tech sector. But I think the point I want to make this morning is that although we've seen a recovery at an index level, this is not last year's market. And that becomes very evident when you break the performance of the S&P 500 down on a per sector basis. And if you have a look at the top 3 contributing sectors to the market's return last year, you'll see that it was a tech story, essentially. Even the consumer discretionary sector was essentially an Amazon story. So those 3 sectors contributed around 17.3% of the S&P 500's total return of 18.4%. The physical economy and the more cyclical end of the economy essentially got left behind. So how does that tee us up going into 2021 from an investment perspective? Well, I think you need to consider the forces that are currently acting on global capital markets. And to my mind, the most obvious and the most powerful of which right now is global monetary policy. The fact is, we're living in a world of zero interest rates, of zero interest rate policy, of ZIRP. And I think we all understand the basic theory behind how lower interest rates result in higher valuations, right? Future cash flows are ultimately discounted at a lower rate, which results in a higher present value. But the current situation is actually far more significant than that. The fact is, global monetary policy right now is historically accommodative. And to illustrate that, I've put this chart up. Now look at the blue line. It shows the US federal funds rate going all the way back to the 70s. And you can see that we're essentially at 50-year lows. And we can debate the usefulness of a chart that goes back 50 years. But even in the context of the last 20 years, interest rates are very, very low. And that's had a profoundly positive impact on market valuations. If you have a look at the brown line that shows the PE of the S&P 500, you can see we're at almost 50-year highs, trading at 30 times earnings. And I think a lot of you will have deduced by now why I'm putting this slide up. And that is to point out what is a fairly clear risk to equity markets in the next 12 to 18 months, and that is interest rate normalization. And I think it stands to reason that given the extreme point that we're starting from, when interest rates do start to normalize, the impact of that on valuations will be equally as pronounced, albeit in the opposite direction. But it's not just about higher discount rates and how they may impact equity valuations going into next year. I think we're also expecting the elevated tolerance for risk that investors seem to have at the moment to normalize. And if you have a look at the 2 risk curves that we've plotted on this chart in front of you, you can see the normal risk curve, and then below it, you can see the zero interest rate policy risk curve. And you can see how mechanically zero interest rate policy has forced market participants to take on more risk. In the case of investor A over here, who normally holds a combination of cash and treasury bills, they have now had to take on more risky corporate debt to earn the same return. Investor B, who normally invests in private equity, has had to invest in more risky venture capital investments to deliver the requisite alpha to his clients. Now, these are all very intentional and very necessary consequences of zero interest rate policy, right? This results in companies which would have been starved of capital during the pandemic having access to capital. So it prevents corporate failures. But unfortunately, ZIRP's also quite a blunt instrument. It also has undesired and unintended consequences, and those sit right at the high end of the risk curve. And right now, we're seeing a huge swathe of excess capital that seemingly has an infinite tolerance for risk. So when you start asking the very good questions like, how can Tesla, which produces 500,000 cars a year, be worth more than General Motors and Ford combined? Why has Bitcoin rallied so hard? Why can Uber, which may never make money, trade at a market capitalization of $100 billion? Well, the answer in all of those instances is most likely zero interest rate policy. And it's just not sustainable. And we're seeing this excess tolerance for risk show up in several different areas. And one of the more interesting places, in fact, is in options trading. So we all know that you buy call options when you're bullish on the market, and you buy puts when you're bearish on the market. And going back to 2015, you'll see that the ratio between calls and puts stays fairly constant. But look at what's happened in 2020. The jaws have opened up, and the volume of call options has started to run away from the volume of put options. And this is indicative of a lot of speculative investor activity in the market. The other area which I find quite interesting is the nature of capital that's being raised in the primary markets through IPOs. Now, this is quite a busy chart, but what it shows you is the percentage of capital raised in the IPO market per sector. Now, I want you to focus on the burnt orange color right at the top there. That shows the amount of capital raised for SPACs, special purpose acquisition companies. Now, these are by definition speculative investments, right? They're essentially cash shells which sit on the market and raise cash from investors, which will be deployed in the future into new operations or new ventures. And you can see that in 2020, around 1/3 of the capital raised in IPOs was raised for SPACs. So that, again, is indicative of a lot of speculative activity in the market. So the point to make is, I think at this point, fear of missing out has displaced calculated risk-taking. Narratives have almost become more important than fundamentals. And bull cases, in a lot of instances, have actually become investors' base cases. So how is that impacting the way we're thinking about investing in 2021? Well, this year, I think we're going to favor grounded valuations, valuations that still make good fundamental sense. We're probably going to avoid being overexposed to the momentum names that did so well over the last 12 months. So by way of example, we like Facebook, Alphabet, and Amazon. These are all stocks that lost a little bit of momentum over the last few months for reasons we'll discuss later. And we're looking to avoid the more obvious momentum names like Airbnb, Zoom, and Uber. But of course, all this talk about interest rates and the inflation that may spark interest rate normalization does beg the question, what will cause this inflation? Now, if you look at an economy like the US, where 70% of the GDP is essentially driven by consumption expenditure, it makes sense that you need to check in on the health of the US consumer, because these are the guys that could ultimately spark inflation. And that's exactly what we did. And that brings me to my second driving force for 2021. Now, to start the story off, I thought I'd use the headline of the Wall Street Journal, I think 3 or 4 days ago. And it read like this: COVID-19 upended Americans' finances, but just not in the ways that we expected. Now, this is a photograph of a woman named Christina Rodgers. She's an optometrist that works at Walmart. She has 2 children and a husband. And going into the pandemic, she thought she'd come out on the other side poorer. She thought she'd have to dip into her savings. But instead, what happened? Well, at the beginning of the pandemic, stimulus checks put around $2,400 in her pocket, and they're about to put another $2,400 in her pocket. She added stocks to her portfolio after the crash, and since then she's up 20 to 30%. And interestingly, she was also able to refinance her fixed mortgage at a rate of 3%, which just 2 years ago was costing her 5%. Now, on a typical $500,000 mortgage, that's an average monthly saving of around $830, which is material. And you're seeing all of this starting to reflect in the macro data that we watch. So for example, no matter the income quartile that you're looking at, the median balance in American checking accounts is up meaningfully from last year. So Americans were sitting on almost no cash last year. Right now, they're sitting on between $250 and $1,000. The average interest rate on a 30-year fixed mortgage, for example, is almost at, well, is at a 50-year low, saving people a lot of money. And interestingly, the average American credit score is actually quite healthy as well. You have to remember that Americans are still quite scarred from the GFC in 2008. So they've been managing their finances a lot better. So they were better prepared going into this crisis. And this is all reflecting in a much higher savings rate. In other words, the percentage of income that consumers save after paying their expenses. And you can see over the last 5 years, it's been hovering at around 7 or 8%. But when the pandemic hit, it skyrocketed to 5 times the normal level, to about 35%. And even as it settled down, as soon as September last year, it was still sitting at 3 times the normal level. So to put a dollar value to this, Americans have basically put away $1 trillion more than usual into their savings. Okay, and this is a really significant number. To put it into context, it equates to around 5% of US GDP. So this is meaningful pent up at least spending power. Now, we're not sure when it's going to hit the economy, but my guess would be it's going to be at some point in the next 12 to 18 months as the vaccinations start to take effect and as the pandemic starts to subside. And this could certainly start to impact inflation. So from an investment perspective, how are we thinking about this? Well, we actually favor consumer-facing cyclicals. So businesses which actually stand to benefit from a little bit of inflation because it helps revenue growth. We're looking to own things like US banks, companies that extend consumer credit, healthcare stocks, which are still beaten up and haven't recovered fully yet, and beach stocks. That's a term that's recently been coined to describe stocks in the hospitality sector. So, for example, we like a business called Cisco, which distributes foods to all of the restaurants in the US. And that's still down around 15 to 20% from its January 2020 levels. And interestingly, this year, we're actually looking to avoid major index tracking ETFs like the S&P 500. Why? Because we think you're sitting with a barbell structure in the market, and you don't want to give up the gains that you make on the portion of the market that still exhibits relative and absolute value on stocks that have probably run a little bit too hard in the short term. Now, the third factor that I want to discuss actually started to become a factor last year. And it's not just playing out in the US, it's also playing out in China, albeit in a slightly different way. But it's becoming very topical now, given the incoming Democratic administration. And that is the issue of antitrust in tech. Now, we all have a sort of cursory understanding of what antitrust legislation is. It's there to allow for the functioning of a free market, but while preventing the prejudice of the consumer and preventing anti-competitive activity, which ultimately stifles innovation, and that negatively impacts growth. But the fact is, over the last while, it hasn't been working too well. And if you look at the tech giants now, they've kind of been through a golden 15-year period where they've been able to run rampant and either acquire their potential competitors. And if that doesn't work, then they simply intentionally run at an operating loss and they bleed their competitors dry until they fail. And because I'm an analyst, I like to put numbers to things. And you're actually seeing confirmation of this in the number of non-merger antitrust cases that the Department of Justice in the US is bringing against US corporates. And you can see going back to the 70s, in many years, there were a lot more than just 5 non-merger antitrust cases per annum. But after 2000, there was only 1 year over the last sort of 15 years when more than 5 non-merger antitrust cases have been brought against US corporates. And the impact of this has been that startups aren't succeeding. So despite what you're seeing coming out of Silicon Valley, startups as a percentage of overall US businesses has dropped over the last 30 years from 14% to just 8%. And this is growth negative. And you can see confirmation of this in the concentration of our equity market. And that's representative of the power that these companies have, right? It's very cheap capital. Now, this is a chart that shows the market value of the 5 largest companies in the S&P 500 expressed as a percentage of the value of the index. Now, I'm going to ask you all mentally just to guess the identity of those 5 companies today. And I'm guessing most of you are going to get them right. And this is who they are. It happens to be the very 4 companies that were summoned to the initial antitrust hearing last year. And that is Apple, Amazon, Facebook, and Google, with Microsoft being the 5th member. And an interesting anecdote that was quoted by Scott Galloway, he's a renowned professor of marketing in the US the other day, struck me. And that is 40 cents of every US dollar raised in venture funding in the US currently is spent between just 3 companies, and that's Google and Facebook, presumably for advertising, and Amazon for back-end web services. And breaking these companies up would effectively have the same impact on the tech sector as a tax cut. But interestingly, I think that's what's got investors in these companies a little bit jittery, because no one likes the sound of a breakup. But the interesting thing about conglomerate structures like Facebook and Amazon is often their acquisitions or their subsidiaries are run as the sacrificial enablers of new growth ventures or other divisions, right? So they're loss making. And by breaking these companies up, you actually force those sacrificial divisions to stand on their own and to start making money. And that can actually unlock a lot of trapped shareholder value. And I think it helps to talk about some examples. So let's start with WhatsApp. Facebook paid $20 billion for this business a number of years ago. This is a platform that's used to send 65 billion messages every day, and it essentially generates zero revenue. If it weren't for Facebook ownership, this might have been the WeChat of the West by now. The second example is Amazon Web Services. This is growing at 30% per annum. It has a 40% market share, and Amazon's valuation, frankly, doesn't reflect the value of this operation. Its peers are trading at 25 to 30 times sales. So there's a huge value unlock opportunity here simply by breaking the business up. And there's a similar opportunity that sits with Google Cloud, Alphabet's cloud operation. Ultimately, we believe that the very typical remedy of breaking up conglomerate structures in an antitrust scenario could end up creating a lot of shareholder value in 2021. So how are we thinking this from an investment perspective? Well, I think that's clear. We're looking to buy into the current weak sentiment. We do own stocks like Facebook, Alphabet, and Amazon, and we're looking to avoid those software as a service stocks, which are already trading at 25 to 30 times sales, simply because the relative opportunity sits in the big cap tech stocks where antitrust has dulled sentiment a little bit. So this kind of brings me to the end of my presentation, and I just want to end off with a brief summary. And the first point to make, I guess, is that we do believe that tech's recent outperformance is justified. Okay, several very powerful secular trends have been brought forward by a number of years. And we do think that tech will continue to outperform the broader market over the long term. And that's exactly why we started and continue to run our global technology fund. However, there are instances of overenthusiasm in the market, and you need to avoid those. And we do believe that you need to acknowledge that zero interest rate policy is having a noticeable impact on some valuations, and this will normalize. Secondly, the cyclical end of the market is pricing in a certain extent of continued pain, and ultimately stimulus and inflation will be catalysts for a positive move there. And that's probably where the big opportunity in the market sits for 2021. And a fund like our Worldwide Flexible Fund, for example, is very well positioned to capture that. Around a third of that fund currently sits in US financials. And then lastly, the regulatory developments that you'd expect to see from a new democratic administration will likely yield investment opportunities. Antitrust is one of them. We think that could actually unlock a lot of trapped shareholder value.